Welcome to Markets in a Minute. My name is Austin Duke. I am financial advisor and chief investment officer for Diamondback Financial. We are a wealth management firm focusing on clients who recognize the need for solid financial advice, who don't want to invest on their own, but still want to be educated through the process. This is the Monday, December 2025 edition. Let's get started. Investment values fluctuate on a daily basis for a variety of reasons, and our job is to figure out what moves we've seen, why we've seen them, and where we think we're going from here. Diamondback Financial is a long-only investment firm, which means we keep your money invested at all times in areas that we feel offer the best prospects for growth instead of trying to, quote, time the market. We focus exclusively on traditional investing in stocks, bonds, and cash. So we analyze fluctuations in the stock market and interest rates to help drive our overall investment process. So we'll start with the S&P 500, which is an index of the 500 largest companies in America. Over the past 2 weeks, we saw the stock market gain 5.07%, which brings our year-to-date gain up to 16.81%. As far as interest rates are concerned, we look at rates that are measured by bonds issued through the U.S. Treasury Department. We believe interest rates are the preeminent measure of investment risk. Rates are factored into every investment calculation, including stock valuations. So generally speaking, lower interest rates will lead to higher stock prices. Higher interest rates can lead to lower stock prices. Over the past 2 weeks, we saw the short-term rates decline significantly, almost about 0.25%. The medium-term, long-term rates were up slightly. So this green line is where we ended on Friday, December 5th. The brown line is where we were 2 weeks ago. The interest rate listed over here on the left and maturity length of these treasury bonds listed on the bottom. Each point represents an interest rate for a given maturity length. We are now fully expecting the Federal Reserve to cut interest rates by 0.25%, so we saw these short-term rates adjust accordingly. For recent developments, we just want to take a step back here to the stock market chart. Most of that 5% gain came during this week of Thanksgiving last week. We had talked about we had received a 5% decline in the market. There was a lot of narrative and reasons surrounding why we thought that was happening, but we see those frequently throughout a 12-month period, at least 3 times on average. So it appears this was one of those run-of-the-mill 5% declines that we have now recovered from. The consumer did look healthy around Black Friday and Cyber Monday sales. We did receive more commentary from Federal Reserve officials suggesting that they were going to be cutting interest rates at their meeting this upcoming Wednesday. But again, like this last week, very flat, not a whole lot going on, and really not a whole lot to report on. I'll just as a kind of a reminder, we had an interest rate cut back at the end of October. At that time, our probability that we would get an interest rate cut in December was about 92%. The day of the meeting, when Jerome Powell said there's no guarantee that we're going to cut in December, that probability dropped to about 69%. The lowest that we could find came on November 19th, and that was at about 29% probability. So again, the stock market had been declining after that meeting, for the 3 weeks after that meeting. We think this is one of the factors, people anticipating that the rates would not get cut in December, but we ended with about a 96% probability here on Friday. So our expectation is that they will cut. We don't anticipate that Jerome Powell is going to cut again for the remainder of his term, which expires in May of next year. But other than being grateful and thankful that the stock market recovered as quickly as it did, not a whole lot else we want to talk about. The economic data has been pretty muted, so things are moving along. We're not growing incredibly fast. We're not declining. We're just kind of moving along. So that's where we'll leave it for that. All right, for our expectations and implications portion, this is one of the last 2 that we will do for 2025, and so we're kind of starting to look ahead to 2026 and what we think we might expect from what's line ahead. Um, this chart comes from JP Morgan Asset Management. Really good visual showing that 34 of the last 45 years had positive returns in the stock market. Something that we've noticed and that we try to point out is that there seems to be a pretty well-defined cycle of 3 years that are positive and then 1 year that's either flat or negative, especially since the financial crisis in 2008. We're okay with a 0% or a -1 or even a -6, but when we start getting some of these larger double-digit declines, those can be hard to handle. But we had three positive years here in the 2020s, even with the COVID pandemic that hit. 2022 was the down year. That's when inflation was high and interest rates were being raised to try and fight against that. And now we've had 3 years of positive returns in the market again. So if history holds, then it would be possible for us to see 2026 that is either flat or negative. Although the financial news media sure seems to feel like there's a lot of positive tailwinds that could lead to another positive year, which, I mean, we're not going to be upset if we have a positive year. We're just trying to make sure everybody's prepared and can see that history suggests that, we've got about a 75% batting average, right? Like we'll have three up years, one down year, and not to be surprised if we end up having a soft year in the market. It very well could be like back here in the 90s where we have solid growth for multiple years, and hopefully that doesn't set up, another dot-com bubble type situation like we had in the early 2000s. But we'll spend a little more time in the next one in 2 weeks going through some of the other things that we're looking at and expecting and implications and how we're planning to invest heading into 2026. But yeah, we anticipate the Federal Reserve will cut interest rates this week. And that will be the last time that Jerome Powell will cut rates unless the economy starts falling off a cliff and he feels the need to come to the rescue. When he's replaced, when his term ends in May, and when he's replaced, we expect that person will continue cutting interest rates. So um, we see a path of lower interest rates going throughout the year, especially in the second half of the year, which again, that could be positive for the stock market. And there's other things that we'll talk about in 2 weeks. But suffice it to say that, there's a case to be made on either side for either a positive or a negative market next year. And maybe that means we end up flat or, low single digits on either side of the positive or negative side. All right, as a final word, I don't really do a lot of Black Friday shopping. I don't like big crowds and I don't like going out in the cold and a lot of other reasons. But I mostly like doing my shopping online, right? Cyber Monday is more of my thing. But I've noticed a trend in recent years, and maybe it's just because I've gotten older and I'm, more cynical or skeptical of things, but I tend to see offers of up to 50% off or, whatever number, up to 70% off as a way to try and get people in the door. And so maybe yes, there are some items that are 70% off, but what you want is only 20% off. And since they were able to entice you in the door and you see that what you want is on a discount, even though it's not what you were hoping for, you're still willing to pay the money and get the item. And I think a similar thing will happen with job layoffs or job cuts. Depending on the company, depending on the size of the job cut, those have to be publicized and they'll say, "Oh, we're going to cut up to 10,000 people." And the financial news media will grab onto that and they'll say, "Hey, they're letting go 10,000 people," which isn't exactly what they said. They can let people go, and that is usually part of the process, but people could leave their job for another one and they just don't replace that person, and that can also count as one of the 10,000. So, um, we had a situation earlier when President Trump took office and they were going to lay off, a lot of people from the government payrolls, and everybody thought employment rate was going to skyrocket and cause a whole bunch of issues, but here we are at the end of the year and we haven't really see that play out. So even though we tend to draft worst case scenarios with a lot of these things, It may not always work out the way it's presented at face value. So, long story short, don't always believe what you hear. Let's wait until we see the actual hard data before we make any decisions on it. So, like I said, this is one of the last two for the year. Appreciate you guys who are faithful followers and watch with diligence. And we'll keep producing these as long as we have people willing to watch them. And we appreciate all of you and hope you have a great holiday season. And we'll see you in a couple weeks.